Good morning, everybody. Happy Thursday. It's March 13, 2025. Great to be with all of you today. My name is Bob Lang, and it's time for our daily bites. Let's take a look. This is going to be a real short one over here because I have to leave a little bit early. It could be we're at 9 o'clock. So we'll just make this for about 5 or 7 minutes or so. But let's talk about the markets here. Obviously, off to a rough start early in the week. We did get a little bit of a bounce back on Wednesday, and we're giving a little bit of it back today. We see S&P futures are down about 10 handles, NASDAQ down about 64 points, Dow down about 63. Dow really took it on the chin most of the day on Wednesday. Apple down quite a bit, and you see actually Apple is down another 60 cents here, down below $220 here. We do have NVIDIA up a little bit over here. Meta did have a nice rally yesterday, but did pull back off the highs, down a couple of bucks here today as well too. So we really do have a challenged market right now, and frankly, a market under distribution right now, and it just simply means you have to stay away from it or have some protection on, as we do at all times, for the extra amount of movement that is being dictated by the sellers. And the sellers are telling you that, you know what, we want to get out. The bears are saying, you know, more downside is going to be coming. And look at the VIX volatility index, which we have closed about 23. It's going to be on the rise today as well too. So we did hit near 29 earlier in the week. We are off those high levels. What is going to be the catalyst to get this market moving again? Well, certainly sentiment has been poor. Confidence is very, very poor. At best, it's bearish. At worst, it's bear market sentiment. And you know, these are things that influence price movements in the markets. And if sentiment isn't good, if sentiment is poor, it's sour, and then all of a sudden we get some weak data coming in. Now today's data, which was the PPI for February, came in a little bit weaker than expected, which is generally positive, right? So let's take a look at that for a moment. PPI came in at flat 0. We're expecting a 0.3. The core came in at minus 0.1. We were looking for a 0.3 as well too, and the year-over-year core came in at 3.4. Expected 3.6. So all the numbers were pretty good, right? But why is the market selling off? It's because the markets are moving on their own right now, and basically not with any influence from some of the data. Well, eventually the data is going to matter, right? Eventually it will. But as of right now, fear is prominent in the markets right now. People are worried that the market's going to go down and it's going to take away some of their gains from last year, maybe even the year before. So we know how people react and respond when they're getting scared, when they're fearful. They sell, right? And when people sell, and there's not any buyers there to step up and pick up the pieces at certain levels, well, prices go down, and that's what we've been seeing. There's certainly a worry there that the economy is going to take a little bit of a step back from where it was in 2024. The Federal Reserve banks that I follow, not just the GDP now from Atlanta, but also the St. Louis Fed and the New York Fed, are seeing about 2%. Those two banks are seeing about 2%. The GDP now a little bit lower than that, in the negative actually, for the first quarter. We do have another couple weeks left to go before the quarter is closed, and so we'll see what happens. Certainly, some of the data that we've seen has been mixed. We've seen some data that is telling us that prices continue to go higher, and we're seeing stickier inflation. We're seeing other data that says that the economy is much stronger than what is being portrayed in some of the other data. So, like the ISM number and the PMI numbers that we follow every couple of weeks. So we'll have to see how things go. But I will tell you right now, this is a great time to lighten up on long positions that you have, keep some puts on, and raise your cash levels. Okay, what those three things? What are those things? This is part of the bear market playbook, right? Are we in a bear market? Well, on a technical definition basis, no. But certainly the action in the prices these days of the markets are indicative of what we see in a bear market. And it's not as severe as we saw in 2022, of course, but it could get to that point, right? So you have to be ready and prepared. Pay attention to what's happening in front of you right now. Don't worry about what happened yesterday. Don't worry about what's going to be happening 3 weeks from now. Pay attention to what's going on in front of you. And the price action is bad, right? Look at what happened on Monday. Look at what happened last week. Can you define it as anything differently than bad price action? You can't. So why do you have to sit there and be punished with your long positions just because, oh, I like Microsoft because it's a great company, or I like Meta because it's fun? Is it fun to lose money? Of course not. So I want all of you to pay attention to what's happening in front of you, act accordingly. And as I was chatting with my good friend Mark Chaikin, he said, "Are you still in the moving business or the storage business?" I said, "I'm always in the moving business. We're in the moving business, not the storage business. We sit there, we pay attention to the action. If something's working for us, great. We'll hold on to it or maybe roll it. If it's not working, we cut it. We're out. We're done. All right." So that's going to be it, everyone. I'm going to again apologize for cutting it short over here. I'll have some more charts and more analysis of the breadth and some other things on Monday, St. Patrick's Day. But I wish you guys all a good day of trading also tomorrow, and have a great weekend. And I will see you guys all back on Monday morning. Take care. Appreciate everyone spending a little time with me today.